Trendlines are widely recognized as one of the most powerful and fundamental tools in the entire trading world. From Forex to crypto and stocks, they are everywhere. But here is the massive problem that is draining your trading account. Most traders are using them completely wrong. If you look at a chart, the most confusing part is that every single trader seems to draw their lines differently. Take a look at this chart as an example. Some traders might prefer to draw the trend line by strictly connecting the wicks of the candles, while others might prefer to draw it connecting the bodies. This leads to a huge question that haunts every beginner. Which one is correct? Is there a secret rule that professionals use that you don't know about? Even if you figure out how to draw them, the next big question is, how do you actually trade them? Should you wait for the price to touch the trend line and enter a buy, anticipating a bounce? Or should you wait for the price to break the trend line, anticipating a total trend reversal so you can short it? The truth is, I have tried all of these approaches in my career. Throughout my years of trading, I have discovered a systematic way to draw and trade trend lines that actually works. This strategy has made me a lot of profit because it filters out the noise. In this video, I will reveal the best strategy for trading trend lines, including an in-depth tutorial on how to draw them properly and how to avoid the deadly traps. Let's dive in. Section 1. Understanding swing points. First, we must answer the basic question: what is a trend line? A trend line is a straight line drawn on a chart that connects two or more swing points in price. Think of it as a moving floor or ceiling. But what exactly is a swing point? This is where most traders fail to be precise. A swing point occurs when price moves into an area and then moves away from it, creating a V or A shape. For example, look at this chart. Price went down, hit a floor, and then reversed back up. This lowest point before price moves away is called a swing low. Our job is to find as many of these swing points as possible on the chart. However, the secret key here is to only mark the swing points that are major and obvious to spot. Don't waste your time with every tiny fluctuation. Look for the ones that stand out. To draw a valid trend line, you need at least two major swing points. Once identified, you simply draw a straight line connecting them. Now, let's resolve the wicks versus bodies debate. The professional answer is, whichever gets you the most touch points. Look at this chart. If we draw the line touching the wicks, we get 3 touch points. But if we shift the line slightly to touch the candle bodies, we suddenly get 5 touch points. In this case, the line touching the bodies is much more valid because the market respected that zone more often. Section 2. Trend lines as zones. An important concept to keep in mind is that trend lines should be treated like areas or zones, not just fixed thin lines. The market is not a perfect mathematical engine. It is driven by human emotion. This means price doesn't have to touch the line perfectly for the setup to be valid. Look at this example. Whether the line is slightly higher or slightly lower doesn't matter as much as the general area of the swing points. If price enters the trendline zone and shows a reaction, it is valid. Stop overthinking the perfection of the line and start focusing on the price action around the area. We can see this in both uptrends and downtrends. By connecting the swing highs in a downtrend, we see the trend line sloping downwards. Even with short-term noise and fluctuations, the trend line confirms the overall market direction is down. Trend lines act as your North Star in the chaos of the charts. They help you spot setups that are invisible to the naked eye. Section 3. Strategy: the stochastic confirmation. Now that you know how to draw them, let's reveal the high win rate strategy. We treat trend lines as key levels, but we don't enter blindly. We need extra confirmation. For this, we use the stochastic indicator. But you must use custom settings to make it effective. Go to your indicator settings and copy these values. %K length to 5, %K smoothing to 3, and %D smoothing to 3. This sensitivity allows us to catch the exact moment momentum shifts at our trend line. The buy entry criteria: 1. Price must hit or enter the trend line zone. 2. The blue stochastic line must cross into the oversold level below 20. 3. Wait for the blue line to cross back inside the oversold level. This is your trigger. Look at this trade. Price hits the line, the stochastic goes oversold, and the moment it crosses back up, we enter a buy. We place our stop loss slightly below the swing low in that area. For the take profit, we target 2 times the size of our risk, 1 to 2 risk to reward. As you can see, price bounced perfectly and hit our target. The stochastic filtered out the false entries and gave us the timing we needed. Section 4. Strategy: the breakout and structure shift. But what happens if the trend line breaks? Normally, a break signals a trend change. But retail traders often fall for false breakouts, where price breaks the line, traps you into a trade, and then immediately reverses. To avoid this, we analyze market structure. In a healthy downtrend, price makes lower lows. If the downtrend is strong, this rhythm continues. But look at what happens here before the breakout. Price fails to make a new lower low and instead forms a higher low. This is a massive sign that the trend momentum is weakening. When price breaks the trend line and forms a higher low, the probability of a real trend change is much higher. We want to see a strong candle close well above the trend line. This confirms that the buyers have truly taken control of the zone. The entry setup. Once we see the higher low followed by a trend line breakout and a strong close, we enter a buy trade. Our stop loss goes slightly below the trendline break area, and we target a 2-to-1 reward to risk ratio. This strategy protects you from liquidity hunts and keeps you on the right side of the smart money. Conclusion and final advice. If you have watched this far, it shows you are serious about learning how to trade. Trend lines are a tool, and mastery comes through practice. Remember, identify major swing points, connect for maximum touches, use the stochastic for confirmation, and always check market structure during breakouts. If you want to become a successful trader in the Forex or gold market, you must have the discipline to wait for the market to reach your criteria. Most traders fail not because their strategy is bad, but because their psychology is weak. They enter trades out of boredom or fear of missing out, FOMO. Unless you make your psychology as strong as your technical analysis, you cannot survive in this market for long. Treat every trade as a game of probabilities. If the criteria aren't met, there is no trade, period. Before the price breaks the trend line, look for momentum loss. In an uptrend, if price fails to make a new higher high and instead makes a lower high, it is a massive red flag. It means the bulls are exhausted. Now, when the price breaks the trend line after forming that lower high, the probability of a reversal is extremely high. This is not a trap, this is a structural shift. The short entry setup. Trading the break. Step 1. Price breaks below the uptrend line with a strong, impulsive candle. Step 2. Look for a retest. We want to see price move back up to touch the underside of the broken trend line. Yesterday's floor becomes today's ceiling. Step 3. Enter the short trade when you see a bearish rejection candle, like a pin bar or an engulfing candle at the retest level. This approach requires patience. Most traders are too afraid of missing the move, so they jump in early. The professional waits for the retest and the structure confirmation. Remember, the trendline break is the warning, but the structure shift is the permission to trade. Part 6. Conclusion and psychology. We have covered a lot of ground today. We moved from the basic definition of swing points to the advanced application of momentum filters and market structure. But there is one final ingredient you need to be successful: discipline. You can have the best trendline strategy in the world, but if you don't follow your rules, if you over-leverage, or if you trade out of revenge, you will lose. Trading is a game of probabilities, not certainties. Even a perfect setup can fail. Your job is not to be right every time. Your job is to execute your process flawlessly every single time. Go back to your charts today. Don't take a single trade. Just practice drawing. Find 100 uptrends and 100 downtrends. Apply the stochastic filter. See how many times the structure shifted before the break. Mastery is built through repetition. Thank you for your time. Stay disciplined, and I'll see you in the next Rober video. Happy trading!